Hello everyone, it is your financial coach Donna, and I want to welcome you back to Growing My Wealth with Donna, a place where we are changing our mindset about money and increasing our wealth. You know, I always like to start my video with a question. So today's question is, how do you envision your retirement? I picture my retirement with many experiences such as traveling, volunteering, enjoying my hobbies, and spending time with family and friends. Does this sound a little like the retirement you dream for yourself? If yes, let me ask you two more questions. Do you have a solid retirement plan? If not, how will you start to prepare for retirement? It takes a great deal of planning, budgeting, saving, and investing for one to retire comfortably. There are so many different retirement plans available to us today, but which one is right for you? Let's see. First, I want to discuss the employer-sponsored retirement accounts such as the 401k, 403b, Thrift Savings Plan, and pension plans. Let's start with the 401k plan. With a 401k plan, the employee can select a percentage or a set dollar amount to be automatically taken out of their paycheck and invested into their 401k account. These funds are invested in stocks, bonds, mutual funds, and cash. Also, many employers offer to match a percentage of their employees' retirement contributions. There are two main types of 401k plans, which are the traditional 401k plan and the Roth 401k plan. The difference between the two is how they are taxed. With the traditional 401k plan, your contributions are pre-tax dollars, and the money grows on a tax-deferred basis, which means you do not pay taxes until you withdraw from your fund in retirement. The Roth 401k plan is an after-tax retirement savings account, which means that your contributions are taxed before they enter the 401k plan account. So now you will not pay taxes when you take your money out in retirement. Keep in mind that only your contributions grow tax-free. Now, the money that your employer puts into your account grows tax deferred, which means you will pay taxes on the match amount when you withdraw the funds in retirement. Now, hear me when I say this. Just because you retire at age 50 does not mean you can withdraw your money. You cannot withdraw money from your account until you reach age 59 and a half. If you take out funds before then, you will pay a penalty to the IRS. So I recommend that you leave that money alone. As of 2021, you are allowed to invest up to $19,500 each year into your 401k plan. If you are 50 or older and need to catch up, you can put up to $26,000 into your 401k plan. The 403b is just like the 401k, but it is for employees who work for a non-profit or tax-exempt organization. The 401k and the 403b have the same contribution limits, early withdrawal penalties, similar tax treatments, and the 403b can be either a traditional or Roth account. The only difference between the two is that the 403b plans are invested in insurance products such as annuities. The next employer-sponsored retirement account is the Thrift Savings Plan. This plan is available to federal employees and members of the military. This plan can be traditional or Roth, and the funds can be taken straight out of your paycheck. There are 5 different funds you can choose from, which are invested in either short-term U.S. Treasury securities or U.S. international or bond index funds. The last employer-sponsored retirement account is a pension plan. With this plan, your employer calculates your guaranteed payout retirement based on your salary history and your employment length with the company. Some experts say that pensions are not always safe because some companies may scale back on pension benefits due to financial trouble or mismanagement with their investments. So be careful. Also, you may want to consider talking with an investment professional to determine if your pension will be enough for your retirement future. As a quick recap, the 5 employer-sponsored retirement accounts are the 401k, 403B, Thrift Savings Plan, and Pension Plan. Check with your employer to see which one is available to you. Now let's talk about individual retirement accounts, also known as IRAs. An IRA is a tax advantage account that individuals use to save and invest for retirement. There are several types such as traditional, Roth, SEP, and simple. IRAs can include a range of financial products such as stocks, bonds, exchange trade funds, or ETFs, and mutual funds. You can open an IRA at most banks, credit unions, and other financial institutions. IRAs are also available through online brokers, mutual fund providers, and other investment companies such as Fidelity and Vanguard. Traditional IRAs are invested with a pre-tax contribution, which means you will claim them as tax deductions now, but you will have to pay taxes on the money with withdrawals in retirement later. You can keep your money in your traditional IRA forever, but you have to start making withdrawals at age 72. With traditional IRAs, there is no income limits on contributions, which means you can put money into your IRA no matter how much money you make. Roth IRAs are invested with after-tax dollars, which means the money you invest grows tax-free and you will not owe taxes when you withdraw your money in retirement. Also, there are no required minimum withdrawals since you have already paid taxes on the money you put into your Roth IRA. Unfortunately, there are income limitations for contributing to a Roth IRA. For 2021, the limit is $198,000 for married couples filing jointly and $125,000 for single people. Rules regarding maximum contributions and income limits for IRAs change each year. The withdrawal rule is the same for individual retirement accounts. If you withdraw money from an IRA before age 59 and a half, you are subject to an early withdrawal penalty of 10%. As you can see, there are some differences between the traditional IRA and the Roth IRA, which is eligibility, income restrictions, contribution limits, and tax growth. You must review each retirement account and determine which one you are eligible for and suitable for you. The last types of retirement accounts are for small businesses and the self-employed. The one participant 401k is for someone who is self-employed and does not have any employees. You can contribute up to $19,500 every year or $26,000 if you are 50 years old or older. Your contributions are tax deductible. Also, you can put an additional employer match up to 25% of your income as long as your total contributions do not exceed $57,000 per year. There is also the Savings Incentive Match Plan for employees, IRAs, also known as Simple. This plan is for small businesses with fewer than 100 employees. In 2020 and 2021, employees can contribute up to $13,500 into the plan, and anyone 50 years old or older can contribute an extra $3,000 as a catch-up contribution. Contributions to simple IRAs are tax deductible. Your investment grows tax deferred, which means you will pay taxes when you withdraw money in retirement. The last small business retirement plan is the Simplified Employee Pension IRA, also known as SEP. It is a retirement account established by a small business owner or self-employed person for themselves. With this plan, only the employer can contribute to the plan on behalf of their employees. For 2021, the employer can contribute $58,000 or 25% of earned income, whichever is lower. The contributions are tax deductible for the business owner only. As you can see, there are several retirement accounts if you are self-employed or own a small business, such as the one participant 401k, Savings Incentive Match Plan for employees, and Simplified Employee Pension IRA. You must select the one that is best for you and your business, depending on your business type and the number of employees. Today, I have provided great information on the many different types of retirement accounts available to you. Now, you must decide which one is right for you and your business. There may be other retirement accounts that I did not cover today. I recommend that you find the right one for yourself, write down your retirement plan, and start saving and investing today. Experts suggest investing 15% of your gross income for retirement once you are out of debt with a fully funded emergency fund. So start planning, investing, and saving for your retirement today. As always, thank you so much for watching. Please leave a comment, click like, share, and subscribe below. Have a wonderful day.